Yo guys, Seth Effects, welcome back to another video. It's been a minute. Kind of like a week. But yeah, let's get into it. Today I'm gonna be showing you how to utilize time and price to fully understand the whole landing kill zone behavior. In other words, how London tends to behave based on time and price. This is kind of like the quarters theory, right? It's kind of like us using the PO3, right? Accumulation, manipulation, distribution, if that makes sense, right? So getting straight into it, we're going to simplify it like this, right? Generally, we have three phases within the market, right? We have Q1, Q2, and Q3. And then Q4 is either a continuation or reversal of Q3, right? In simple terms, Q3 is our distribution phase, right? Distribution, in other words, meaning that it's the true market direction, meaning that it's the direction in which the markets are willing to go after the manipulation. So this is kind of like the power three, right? But it's pretty much fractal to even sessions, because we're not only using the daily candlesticks, you can even be using hours, different time frames, and even sessions, right? It pretty much starts all the way from seasonal tendencies, scaling down into weekly tendencies, right? And then daily tendencies, and then session tendencies or session shifts, if that makes sense, right? So our first quarter is our accumulation phase, which is pretty much from midnight to 1:30 a.m. Everything is in New York time. Our second quarter is our manipulation phase, right? From 1:30 all the way to 3 a.m. Our manipulation phase is pretty much when price goes the opposite direction, right? It's kind of like it's looking to stop our retail, if that makes sense, right? Accumulation, we're collecting orders. Manipulation, we go the wrong direction to trick people, right? Distribution, that's when we go our true direction, right? And then Q3 is simply a continuation or a reversal, right, of Q2, meaning that it's either going to be Q1, Q2, or Q3, because sometimes it could even be an accumulation phase, and then now Q1 becomes a manipulation phase, if that makes sense. But the time zones that we pretty much stick to are this fixed one right here, whereby these times are fixed to the quarters, if that makes sense, meaning that every time within this time zone, right, or this time scale, right, so we're going to be looking for an accumulation every time. And then during the manipulation phase, we're looking to see price sweep the Q1's high or low. If we're bearish, we want to see price go above Q1 and then draw lower heading into Q3, right? Meaning that from Q3, we'll be pretty much looking for our entries going lower, right? So like right now, I'm going to show you an example on pretty much live stagnant charts, right? That makes sense. So we've got our London session here, or our London kill zone. In simple terms, we divide a 24-hour range into quarters, right? And our first quarter is from midnight to 6 a.m. New York time, if that makes sense. So what we do after we do this, right, we divide it into quarters, and then this is where the algorithmic behaviors kick in, right? Whereby the first one is Q1, second one is Q2, third one is Q4, and then fourth one is Q4. Q1, Q2, Q3, Q4, if that makes sense, right? Q1 is our accumulation, Q2 is our manipulation, and then heading into Q3 is our distribution. And also bear in mind, it's never going to be fixed to time, whereby now when 1:30 a.m. hits, that's when price is going to sweep buy side, right? All this can happen within a fixed range, kind of like the highest chance of you getting your manipulation line will pretty much be between the Q1's half, meaning that from half of this all the way to the end of Q2. Yeah, right, and our distribution phase will generally begin halfway from our Q2, moving to Q3. Same with the Q4 one. It's most likely going to begin halfway from Q3, moving to Q4, if that makes sense, right? And this is pretty much how it looks on stagnant charts, right? And then if we clean it up, this is how it looks. Our first one is our accumulation phase, and then we treat 130 as our new day open, meaning that within this time scale, we're treating it the same way we'll treat the midnight New York Open as our true open day range, right? So we generally treating 130 as our London open day, right? And then now we outline our accumulation, right? And then this blocks above our standard deviations, right? Our standard deviations are just projections, if that makes sense. Meaning that every time you get your accumulation range, right, you're gonna utilize 3 standard. If you're bearish, you're gonna utilize 3 standard deviations above the accumulation range. Meaning that this one is our first one, this one is our second one, and then this one is our third one, right? And then above the third, we generally looking for entries between this range right here, from this high to this low. As soon as price goes above the third standard deviations, the odds of your trade playing out, your high probability reduces significantly, if that makes sense, right? And like the best way I would utilize this, right, is as soon as price sweeps out the accumulation highs, right? We want to see price as price is moving higher like this. We want to see it draw into a higher time frame PDRA, right? Which could be a favorably gap within this range, meaning that, for example, could have been here, dragging it out all the way to your high right here. I'm just not including it here just to keep everything clean and simple, right? And then I would expect some form of displacement here, right? And there's pretty much 2 ways I identify shifting market structure, right? As soon as price creates a favorably gap like this, right, and then price closes below it, it becomes an inversion favorably gap, right? I treat this the same way I treat breakers, if that makes sense. And if I want more confidence, I would scale into a lower time frame and then look for a breaker just above the inversion favorably gap, right? Then we look for our entries to draw lower, right? And then our first draw on liquidity would be this low right here, which is our accumulation low, right? Our second draw on liquidity would be 2 times this range, meaning that you take this low to the reversal to this high, drag it lower, 2 times the range is our drawn liquidity, right? And then if you wanna hold it way longer than that projection, right, you'd be looking for PDRA below price. That price is most likely drawing into, right? Because usually when Q3 reverses, that's when price features a higher time frame or a current time frame PDRA, right? Meaning that it's gonna be utilizing that as a reversal for higher prices. The same way here, it draws lower. It used a bearish PDRA to drive price lower. Then here, it used a discount array, to drive price higher. And you can identify that by your displacements, right? So pretty much, I would say the easiest ones I personally find are the easiest to trade, right? It's the distribution phase and the continuation or reversal, especially when you're looking for reversals. It's just that they're a bit harder to trust, but as you backtest and learn to see them, it just becomes easier, right? And then this is pretty much your session candle. This is pretty much how we're projecting it. The same way we're utilizing the PO3 on our midnight open is the same way we're using it based on our session. Kind of like this from midnight to 6 a.m. This is our candle projection, if that makes sense, right? So price opens, draws higher, right, in our manipulation phase or our Judy swing, right, drawing into a PDRA or high time frame PDRA. And also bear in mind, if price sweeps the accumulation high, right, that's pretty much still enough for you to trust that price is going to go lower, right? It's just that your probabilities increase when you have two PDRAs or two tools that are in confluence with each other to drive price lower, right? So hope you found this helpful, and if you found this enlightening, just be sure to subscribe, be sure to hit the like button, and if you got any questions, just hit them up on the comment section.